All right, folks, welcome back to the Property Couch podcast, and have we got an excellent episode for you today. Special guest, heavy hitting, authority in the space. We are talking with none other than Tim Lawless and the spring listing season that's coming up, Ben. What else are we covering?
So we're going to look at supply and demand in more detail, but we're also going to double click on this whole idea that obviously with lending restrictions, where is that pushing all of that demand? So where are those opportunities in the market in the short term? However, what does it mean for long-term growth as well?
What does it mean? You'll have to listen to the show, folks, to find out. Let's rip into it now.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance, and money management.
All right, folks, welcome back to the Property Couch podcast, and welcome back to you too, mate.
Good old Collingwood forever.
We have been a little
minor premiers. Do you get any silverware for minor premiers?
Yeah, but don't you leave yourself as open as a chemist when you say stuff like that? Because like you've been here a few times, and you've dropped.
When we go out in straight sets, we haven't taken the best form into the finals. But congratulations to the boys. Well done on obviously a great season. Most weekends I was happy. That's all you can ask for as a supporter. Most weekends I was happy.
Gee, the swag is annoying. But hey, can you smell that, Ben?
Ooh, no, what's that?
Spring. Spring's in the air.
Ooh.
Tomorrow, first day of spring.
Ooh, very exciting, yes.
Yes.
So tomorrow coming up. It's my dad's birthday also. Happy birthday, Dad.
Oh, well, mate, you get a brownie point for that.
1st of September.
But given that spring is in the air, Ben, we thought it would be a good idea to bring in the very trustworthy, the very reliable, the very authoritative figure when it comes to all things spring listing season in Tim Lawless. So we're excited to have a conversation with Tim today. It was a very, very insightful chat. We think our audience will benefit enormously from that. So given we've got such an important guest waiting to chat with our community, Ben, I think we might just crack on today with the top of the show. So obviously, I'm getting close to the end, Ben, of the anecdotes with Morgan Housel here. So that's a bit like, remember when I read How to Win Friends and Influence People? I think it was a good idea at the time, and then
Still a good idea.
It takes a while. But the insights have been so powerful. But today we're up to number 11, the social signaling aspect of money on both things you buy for yourself and charity given to others, right? So Morgan talks about if you get public recognition for donating money, it's not charity, it's philanthropy. Good distinction. And if you demand recognition, it's not even charity, it's a business deal. Oh, very good. So there is a clear social benefit to you, the giver, in addition to the recipient. And it's not negative, because good donations to worthy causes would plummet if donors didn't get recognition. But he sort of gets the parallel around spending. So he says most forms of spending are like that. They have two purposes. Number one, to bring some form of utility to the owner. And number two, and the related concept, to signal something to other people. Makes sense, right? So homes are like that. Cars are like that. Clothes, jewelry, but even travel. How many people choose a destination based on how good, in part, and I could see you doing this, Ben. I reckon you'd be susceptible to this, but in part on how good the Instagram picture they could take.
I can't wait to share my Instagram pictures.
Just sounds cool to go there. You are the antithesis of making decisions around what it would look like on Instagram, which is why it's a bit chuckly here. But people don't communicate on social media. They perform for one another. I like that. If you realize that social media is a place that people go to perform, I really love that. So spending money is like that too, and it's not always a bad thing. But if you thought about what clothes you'll look best in before you leave the house in the morning, you have engaged in signaling. But here, let's bring this home. The thing to recognize is spending money on yourself is often done with the intent of influencing what other people think about you. So that should spark three questions. Number one, whose opinion are you trying to influence? Number two, why? And number three, are those people even paying attention to you? The man in the car paradox. So, Ben, we've covered a fair bit now. Number one was your family background and past experiences influencing your spending preferences. Number two, entrapped by spending. Number three was frugality inertia. Number four was the emotional attachment to large purchases. Number five, the joy of spending can diminish as income rises. Oh, that's true. Number six is asking $3 questions when we should be asking $30,000 questions. Number seven is social aspirational spending is trickled down consumption patterns from one socioeconomic group to the next. Number eight is an underappreciation of the long-term cost of purchases with too much emphasis on the too much emphasis on the initial sales price. Number nine, no one is impressed with your possessions as much as you are. Number 10, not knowing what kind of spending will make you happy because you haven't tried enough new and strange forms of spending. And number 11, which we covered today, was the social signaling aspect of money on both things you buy for yourself and charity given to others. Folks, we are close. We're going to bring this home very soon in the next couple of episodes, Ben.
Well, Bryson, we actually talk to that point quite specifically when we talk about human interest and human behaviour, and we talk about owner-occupier appeal.
Yep.
Yes, as much as I'm not going to send everyone my Instagram pictures of where I'm holidaying or that type of stuff, I'm not necessarily that socially overt. I, like other people, do buy into this idea that I want a lovely home and I do want to create great memories in there. And yeah, I'd be lying to everyone if I didn't say that it doesn't make me feel good. So it is that status, that human interest and human behavior that is part of what we look at when it comes to location, what we look at when it comes to the properties that may have an outperform result for the improvements on the land. But of course, we all know it's the land at the end of the day that does the heavy lifting. That's the biggest focus we have on land to asset ratio. But we do know that some of these prize properties have a Veblen effect, and they ultimately, result in incredible results for those particular properties as well. Because guess what? People want to live in Vaucluse. They want to live in Toorak. They want to live in these locations, and that is also fundamentally true as well.
Well, Ben, you do have a lovely home, but it should spark these three questions for you, mate. Whose opinion are you trying to influence? Why? And here's the third kicker. Are those people even paying attention to you?
No. Well, to me, they are.
Well, here's the deal. Most of us think that people are, so we are going to continue to think that the man in the car paradox doesn't exist. So therefore, that will continue to drive the behaviours of people around real estate. So therefore, if we break that down, we don't want to.
And that's why we study economic behaviour in terms of human interest and economic behaviour, because it's true.
Yes.
And it's very much made up in the property values that we have in this country. Because if people have got the money and they want to show off, they put a lot of it into their property.
Yes, very true. It's a public display of how good we're going. Hey, let's get into today's topic, Ben.
Yes.
You and I recently caught up with Tim Lawless. It was a wonderful conversation. We think our audience is really going to enjoy it. Let's cut to the conversation right now. All right, Ben, we're speaking to a very special guest today. We are chatting with Tim Lawless, who's one of Australia's leading property market analysts and commentators. He was the founder of Corelogic's Australian research division, formerly known as RP Data. Tim's expertise is sought by governments and regulators, as well as corporations in the property, banking, and financial sectors. As research director, Tim heads up a team of analysts in Australia and New Zealand and reports on property market conditions and the interplay between economic and demographic forces. Tim is now a 5-time returning guest. Welcome back to the Property Couch, Tim.
Thanks, Bryce. G'day, Ben. It's been 5 times. Wow, okay.
5 times.
Time flies.
Actually, I did look under the bonnet. Back on the 18th of 11th, 2016, episode 156, which was in 2018, 336, which was in 21. We spoke to you last year, which was episode 412, and here we are today in episode 458. So,
Wow.
But we've always sought your feedback and commentary. You are one of the leaders in the space, and one of the questions that we often ask all of our guests is the money backstory, but we did that with you back in episode 412. You told us that your wife Amanda was the banker, and you guys had a really cool backstory around money and how that worked in your household. But what was really encouraging, because I listened back to it yesterday, was that you did talk about finance and mortgage and debt with your kids. So that was super encouraging. So I guess the only question I got for you today is, have you had many conversations with the kids of late around just the sheer size of the tightening cycle, or is it sort of just business as usual at the Lawless household?
No, absolutely. We're having all those sorts of conversations. So my kids are, my son Finn, he's finishing year 12 this year. So he'll be going to uni next year. So finances are becoming all the more important because he's figuring out, to pay for fuel and entertainment and so forth. There's not a mum and dad fund that can be relied on anymore. So, he's working pretty hard. And my daughter Madeline, she's in grade 10, grade 11 next year. And she wants to do a lot of business-oriented subjects because they obviously getting into grade 11 and 12, getting to the pointy end, they get to choose a lot of their subjects to kind of guide where they're hoping to go. So she's getting into economics and maths and a lot of sciences. So, definitely all those conversations are happening. And maybe that's the silver lining of all this uncertainty we have in the economy is it makes for a really, really good dinner conversation.
Yeah, well, those kids are lucky to have that resource, which we touched on. So, folks, if you want to go and listen to the full backstory, go and check out episode 412 for a couple of reasons. One, you get to learn a little bit more about the Lawless household, but two, it was a great episode because you wrote a report about the longevity of property and you did analysis over 30 years, which Ben and I really enjoyed, and it kind of gave your version of the Vanguard chart where you had the the performance of property over 30 years and all of the the X factor events that happened over the journey. So it's well worth going back and having a look. But I guess what we want to talk to you today is about your latest research paper regarding, well, the title is "A Rise in Fresh Listings Will Test the Depth of Buyer Demand in Spring," which obviously piqued our interest. So we'd love to get under the bonnet with you to chat about this. But before we do, has it been a popular research report, Tim, of lots of people wanting to pick your brain about it?
Yeah, absolutely. I think the advertised stock levels have been a really important feature of the market, both through the rate hiking cycle to date, but also obviously as we come into a more seasonally active part of the cycle, coming into spring and early summer is always a lot busier in terms of listing numbers coming into the market. It's going to become even more interesting. And I think one of the key factors we've been seeing really supporting housing prices to date is really low advertised supply levels. It's not like demand is rocketing along. We're seeing the number of purchases in the market is roughly around the 5-year average. So even though population growth is booming at the moment, most of that flows into rental demand and then gradually into purchasing demand. So fundamentally, if we do start to see a shift in available supply or advertised supply, and it starts to get higher against a backdrop of demand at relatively average levels, then we could start to see some heat coming out of the market. In fact, we're already starting to see that a little bit in some of the markets that have really led the recovery cycle so far, like Sydney is just pretty clearly eased back in the pace of growth.
Tim, this is obviously a fascinating question, right? Because we started 2023 with a lot of uncertainty. We were in a downward market at that particular time. And there was a lot of commentators and economists who were forecasting further deterioration of property prices. And to their surprise and to many, what we have seen is, that sort of loss aversion, that human behaviour kicking in. Now, that has obviously been subsidised by, really strong unemployment level or employment levels, low unemployment. And so we're actually in a surprise environment where we've got this super strong tightening cycle, but we've actually got prices increasing, yet a lot of people have been tapped out from, in terms of their ability to actually access finance to be able to do that. So it is a fascinating dichotomy of what's going on in terms of being able to see price growth when traditionally higher interest rates means further declines in values.
Yeah, it is surprising. And normally when you look at a market that's turning around like it has, this positive inflection we've seen since about February or March of this year, normally that would coincide with interest rates coming down or freeing up of credit or maybe some fiscal type policy that like a first home buyers grant boost or something like that. None of that's happened. So we're seeing housing prices rising, as you say, Ben, against this backdrop of really high interest rates, a really heavily indebted household sector, sentiment that's around recessionary lows or close to recessionary lows and holding there. So that's why it's really surprising, but it's a really good testament to just economics 101, where you have really low supply levels and demand is outweighing supply, and that's simply pushing prices higher.
If I can build on that story, Tim, what was also a bit of a surprise for me was that it was, and this is traditional in most cycles, that the 75% quartile usually leads that price recovery. So it's the most volatile in terms of usually has the biggest fall, but over the longer period, as you've demonstrated in your 30 years of research, it's that top quartile that does significantly well over the long period of time. But I was thinking with these really high levels of serviceability, that taps those people out. So if they've lost 30 to 40% of their borrowing power capacity, but yet that was the recovery in terms of the Sydney market. We saw the Sydney market, clearly it was the top 75% quartile that led that. And I think from memory, looking at your chart pack, that also Melbourne has showing that evidence. It's a little bit more balanced in other markets like Perth and that type of thing. But obviously part of your hedonic index has a stronger weighting in the Sydney and Melbourne markets in terms of how you value your overall national price point for dwellings.
Yeah, well, absolutely. The index is weighted. So larger markets with more properties and higher value properties tend to push the combined capital city benchmark or the national benchmark around a little bit, which is why it's really important to drill down and look at what's happening across each of the cities and the sub-regions as well. But absolutely, it is that upper quartile in Sydney and Melbourne that has really driven the stronger conditions. But we're also seeing values rising across the lower quartile as well, just not quite as quickly. And arguably, it's that upper end of the marketplace that's probably a little bit more insulated from high interest rates. You tend to have a lot of, say, subsequent buyers that can rely on, say, previous equity accrual to get into the market. They're probably not as reliant on credit. And in many cases, there'll be what a bank would be describing as a high quality borrower. Essentially, that simply means they might have low debt levels relative to the loan that they're applying for, or low debt levels relative to their income as well, which tends to put them on a better footing for getting the best mortgage rates.
And there was such a small amount of stock of that high quality stuff. One of the things that Bryce and the buyers agency team in our business was saying is, pretty much for the past 6 months, the quality of that A class, that sort of B class stuff that we like to buy for our clients was just scarce on the ground. There was a lot of sort of C and D class or inferior located properties or whatever that wouldn't give us what we call a quality asset for a sustainable decade, 2 decade period. So what we have seen in this increased listings as we're coming into the spring season, the feedback we're starting to get from our buyers agencies, the quality is improving. And I think that's interesting in terms of how that plays out over the course of the next 6 to 8 weeks.
Yeah, it'll be really interesting. I think we've seen vendors or prospective vendors just waiting on the sidelines for so long now. And I think as we see the market, becoming stronger, we're seeing values rising. We generally see new listings following that trend as well. So vendors are probably feeling a little bit more empowered or a little bit more confident to test the market. But also, as we move through this period of high interest rates, and it looks like we'll probably be moving through high interest rates for another year or so before they start to come down, arguably we'll probably also start to see more signs of stress as well. I think the market's been quite resilient in that sense so far, that most borrowers are on track with their mortgage repayments. But as we see, more people migrating off a fixed rate onto a variable rate that's much higher, as well as simply, household savings being depleted and maybe changes in household dynamics that might, lose a job, lose one income, whatever, then arguably we're going to start to see mortgage arrears picking up and more people having to sell. I think to date we haven't really seen too much evidence of that, but it's probably something that will start to show up to some extent through the second half of the year and into next year.
And they all combine to create momentum too, Tim, because there's a lot of sellers would be sitting there going, well, that's fine that I'm in a position I want to sell, but the challenge they have is they can't find rental stock given the crisis, and they're concerned about selling, fine, no problem, but not having anywhere else to go. So it could be a self-fulfilling or a self-perpetuating challenge to your point around it could be a tipping point where we go, all right, well, now that's because it had to break somewhere, right? Because, what was the chicken or the egg? Which one was to come first?
Yeah, absolutely. And I think that's such a dilemma that if you are looking to sell your property and move into the rental market, rental markets have loosened up just a little bit, but we're still seeing vacancy rates typically around sort of 1.1, 1.2% across most capitals. Or in markets like Perth and Adelaide, vacancy rates are still below 1%. So yeah, I think that's going to be a real sticking point. And if you need to sell and go into the rental market, it is, I guess, just beset by a lot of uncertainty. It's probably another reason why I think Australian borrowers are really going to be quite fixated on staying on track with their mortgage repayments. And to do that, you'll probably find there's going to be a further pullback in discretionary spending wherever households can, just simply to stay on top of their repayments and make sure that they're not getting into any sort of financial strife alongside their debt.
If we have a look at some of the data, you start your report by saying that new listings have been increasing since mid-June, which is really contrast to the usual season trending. So can you talk to us about what you observed and interestingly, you talk about a pre-COVID 10-year average, and then you compared currently. So it'd be nice to sort of give our community your thoughts there.
Yeah, so a little bit of context in the listings trends for starters. So we've generally been seeing the flow of new listings tracking lower since about September last year. So, and that also coincided with when we started to see the rate of decline through the rate hiking cycle started to ease off as well. So it really ramped up between sort of May through to about September last year in terms of value falls were accelerating. And then they started to the rate of decline started to ease off as we saw supply shortages becoming more apparent. So what we started to see through winter now, as you say, is a little bit unusual. It's this upwards trend in new listings. So normally between autumn and winter, we see about a 5% drop in the flow of new listings coming on the marketplace. Simply, the months are colder. Presenting your properties not quite as good as what it is in spring or summer. People are less willing to go outside and go to open homes, all that sort of stuff. So what we've seen through winter to date is actually a 13% rise in the number of new listings coming on the market. So completely bucking that downwards trend. And as we move into spring, the normal seasonal trend, again, based on that pre-COVID decade average, would be about a 10% rise in new listings coming on the marketplace through spring compared to winter. In fact, last spring was the first time we've ever seen spring listings or spring new listings lower than what they were in winter. So there is a bit of probably accumulated supply in the wings here. So what we're expecting is this trend will probably continue into spring and early summer. We've seen an early start to the listing season. I think a lot of prospective vendors are probably looking to beat the rush to some extent, get into the market when they know supply levels are really low, when they know selling conditions are still quite strong and values are rising. But as we get into spring, if I'm right, and we see this trend continuing to rise, then one of probably the key pillar that's really been supporting housing prices is starting to become a little bit less solid. That low supply is now rebalancing. And to the headline, which you mentioned a bit earlier on, this will really test the depth of buyer demand. My guess is we probably won't see buyer demand lifting as much as what we see listings rising through spring. For the reasons being that you outlined at the beginning of the podcast, the fact that access to credit is still quite challenging. We've seen about a 20 to 25% reduction in borrowing capacity. Sentiment is still really low as well, which is in itself quite the blocker. So what we're probably at the cusp of now is just a gradual rebalancing between available supply and demonstrated demand of the market, which will probably take a little bit of heat out of the pace of growth we've been seeing since early this year.
Yeah, Tim, that's something that Bryce and I talked about recently on an episode where we did our mid-year review, where there is certainly, when you think about the national market, there's this concept that the heat in the market or the sort of price growth will run out of puff, as that supply arrives and the depth of demand is tested. We're getting a lot of questions from customers coming to us and asking us to sort of help them around the fixed rate cliff. And, we know that over the course of these next couple of months, we're seeing another bulk amount of people coming off those fixed rates. And you've been kind enough to supply me with a fair bit of data around challenges for investors in terms of the increased listings from some existing investors who may be overstretched in terms of their portfolio. What's your read in regards to, you mentioned a little bit earlier about, mortgage stress being another catalyst for potentially bringing further supply on. Have you got any other sort of evidence to suggest around the fixed rate cliff and what's happening there?
Yeah, a few bits and pieces, and the unfortunate reality is there is a bit of a lag in a lot of the key data we look for to look at mortgage stress. So the most recent APRA data, for example, is up to the March quarter, but that data showed that 99.5% of all borrowers were on track with their mortgage repayments. So let me rephrase that. So 99.5% of all borrowers were less than 90 days behind on their mortgage repayments. So essentially, there's very little evidence that borrowers are falling behind at the moment. But that 0.5% had risen from 0.3% back in September last year. So it's gradually just starting to rise from absolute record lows and still remains very low. To put that 0.5% into context, pre-COVID, you generally see around about 0.7 to sort of 0.9% of all borrowers running a little bit behind in their mortgage repayments. So we're not even back to pre-COVID levels just yet. Another thing we can look at would be something that's a bit more timely, and how many homeowners are actually selling their property after a really short hold period. Eliza Owen did some really cool work on this a month or so ago, and it looked at what proportion of properties sold within, say, 2 years or 3 years of being purchased. So that's clearly rising, but again, from really low levels to a little bit above average now. So again, that's probably another, I guess, just warning sign that we are starting to see some buyers who probably bought around the market peak and have run into some financial stress are being proactive and offloading their property before they really are forced into that position. And to be honest, if I was in that position, I'd be looking to offload now as well. I think selling conditions are really good. Most people can sell their property and probably get rid of their debt. It's very rare to see instances of negative equity in the Australian housing market, but there are going to be some examples of that. And so I think going forward, watch that APRA data. We see the June quarter update coming out in early September. And my guess is that will show a more material uplift in, say, pre-90-day arrears and post-90-day arrears. But again, from really low levels to something that's probably getting back to more around average levels.
But it's impacting the markets as we've been trying to educate on this podcast for some time. Australia is not one big market, so you've identified across around the grounds that there's certain markets that are performing well and certain markets that in terms of price growth. But there's a couple of observations here. You said cities where advertised supply levels have risen have also seen a reduction in the pace of value growth, but also on the flip side, those with tight supply levels have seen accelerated value growth. Can you talk to some of those observations, Tim?
Yeah, there's some really clear examples here, and I'll use an updated data set rather than what we published a couple of weeks ago. So I'm looking at data for listings up to the 4 weeks ending the 20th of August here. So really fresh, and it shows markets like Sydney and Melbourne really stand out. So total listing numbers in Sydney, they're still below their 5-year average and lower than a year ago, but they're getting pretty close to those levels. Melbourne listing numbers are now 5% above the previous 5-year average. So clearly some upwards pressure here. And you can see the trend is clearly rising from quite low levels. New listings coming into Sydney are now about 21% above the previous 5-year average for this time of the year. and about 31% above average in Melbourne. So we're definitely seeing signs of more fresh stock coming in the market in those two cities than other cities. And total listings finally are starting to trend a little bit higher. And if you look at the growth trends in Sydney and Melbourne, even though they're still positive, Sydney has seen the monthly rate of growth pretty much halve from about 1.8% back in May down to 0.9% at the end of July. And just looking at our high frequency indicators, that's holding at around sort of 0.8% month on month growth now. Melbourne's dropped from about 1.3% growth down to 0.8% now. Whereas markets that have remained really tight, if not even tightened, I think the best example here would be Perth, where we're seeing total listings in Perth about 45% below the previous 5-year average and trending lower. Even though new listings are sort of around the 5-year average, it's a really rapid rate of absorption in the Perth market. And that's a clear example where we have seen an acceleration in the rate of growth. Brisbane, stock levels about 40% below the 5-year average. Adelaide's about 41% below the 5-year average. And again, these are markets where we've seen the rate of growth accelerating. In fact, those three markets, Brisbane, Adelaide, and Perth, are all showing the strongest month-to-month growth now, at least across the major capital cities.
Do you see those markets as having more affordable properties being a big factor in that as well, given that lending is such a challenge, and you're finding that largely by all of the restrictions that you have in place, the buffers you have in place, it's kind of driving people into price points that lend themselves to those markets. And then if you have a concentration of people who are looking over the borders as well, going, well, I'll be in those markets as well, it kind of becomes a bit self-fulfilling too, doesn't it?
Yeah, absolutely. That's such a good point. I mean, Perth, I think, is remarkably undervalued. To be honest, it's a market that's our fourth largest capital city, yet housing prices aren't all that much more expensive than buying into Darwin. It's the second most affordable capital city after Darwin by some margin. Adelaide's still very affordable, but for locals, interestingly enough, because Adelaide incomes tend to be a little bit lower, housing affordability is still a bit challenging in that market for domestic or local buyers. But interstate buyers coming into those two markets, I think that their dollar value goes a lot further than their own local markets. So yeah, I think that's a big part of it. Another explanation as well also comes back to a more, I guess, holistic level of housing demand in those markets, particularly in Brisbane and Perth, where you have a really strong rate of interstate migration that's supporting purchasing demand, rather than just, say, in Sydney and Melbourne, which is completely being driven by net overseas migration. It tends to have a much more influential effect on rental demand than purchasing demand. So I think that rate of interstate migration that's very positive in Queensland and WA would be another factor that's really supporting purchasing activity.
Well, that comes to the affordability story, doesn't it? In terms of, those people who are arriving here and, wanting to set up their great Australian dream, and as part of that. But to build on Bryce's point about this concentration, what's obviously a clear observation from where I sit as well is the fact that when you've got APRA has a 3% buffer rate, one of the unintended consequences of a buffer rate like that is reducing that borrowing power of the investor as well. And so, to Bryce's point, all roads for investors are really leading to that price point of 400 to 600,000. And they're scouring the country at the moment in terms of looking for those opportunities. So the unintended consequences of APRA's policy there is that the first home buyer and those people who want to get into a property are now competing against the cashed up investor who is moving the market. There is no doubt in my mind they are artificially inflating the market with so they're all thinking they're geniuses because they're picking the best market. And hey, we're playing in that space too. We've got entry-level investors who need a bit more income as part of that particular story. But in my mind, it's pretty clear that if APRA keep restrictions on borrowing power for the next few years and keep the buffer rate at that 3%, the reality is you're going to continue to force concentration of investment into those cheaper markets. And that's going to be challenging for owner-occupiers in terms of, their ability to get in when, if a price point, we know it from our East Coast clients and how the market works. if the price is offered at 400 and, the first home buyer in that market has a ceiling of 420, they'll just go 422, 425. I mean, what's 25 grand for me as part of my portfolio? So that's the frustrating bit in terms of what's happening when it comes to, these macro prudential, throttles.
Yeah. So with that 30 basis point buffer, or 30 basis points buffer. So typical mortgage rate, what, around early sixes? So you're getting assessed early nines for an investor. You've already got a 30 basis point premium you're paying above owner occupiers as well, which makes it a bit harder. And of course, even though rents are really tight and rental income's going up, rental income hasn't gone up anywhere near as much as what mortgage repayments have. Just use a market like Sydney as a good example. We've seen just the past year, not even looking at since rates started to rise, just the past year to July, typical mortgage repayments for a Sydney investor are up about $1,200 a month, and their rental income's gone up by about $350 a month. So there's a massive disconnect there. So I think just trying to get the cash flow equation, or just simple maths, down is becoming really hard, especially when you're getting assessed at a higher interest rate than what you need to repay at. As well as the fact that I don't think APRA is really going to adjust that buffer rate until interest rates start to come down. So I think the reality is that 3% buffer is going to stay there for some time.
Do you think that you hinted before about the population growth story with the immigration that goes into the rental market first and then filters its way into purchasing? Do you see that would help potentially have an underpinning to your point here, that if they usually come into the rental market, then they see an opportunity when they land here through stock, that could help form the basis here?
Well, yeah, I think overseas migration will gradually flow into purchasing demand. And it's probably happening a lot earlier than it would normally through normal overseas migration, just because rental markets are so tight. But we've got to remember that a large component of net overseas migration is temporary migrants. It's students, it's short-term visas and so forth. I can't really see that component of migration really flowing into a purchasing decision at any time in their stay. This is mostly about permanent migrants, skilled migrants, long-term migrants. And I think as they confront these really tight rental conditions, they probably are looking to fast-track their purchasing decisions wherever they can. If they can afford to do so, they're going to find the right stock. It just eases the uncertainty in finding shelter. There's probably also an element of maybe foreign buying picking up as well. We can see that in the latest NAB survey that foreign purchasing activity is lifted from its COVID lows back to roughly around pre-COVID levels as well. So maybe if we are seeing some foreign students really struggling to find accommodation, there could be a family benefactor looking to purchase an investment property for them. Remember, foreign buyers need to generally buy new or land and build and so forth. So there are restrictions there, but I wouldn't be surprised if there's a slightly different mix of foreign buying activity starting to happen amid really tight rental conditions.
Tim, we've got a really good summary that you gave us earlier around Melbourne, Sydney, in terms of probably going to a more open supply story, and you've told us that Brisbane, Adelaide, Perth really challenged. We do know, and we've mentioned on this pod many a time, about Hobart's also got a significant amount of supply in that particular market. Darwin's also a little bit contracted, but Canberra is also one that will probably see more supply coming in. But what was fascinating also was when you went down into some of the sort of regional area analysis and you showed the SA3 levels, and you were talking about the largest rises in some of those areas. And there were some clear patterns, wasn't there, in terms of the particular marketplaces where there was a larger amount of supply coming in compared to the 5-year average. And then on the other side, you've also got this drop in listings, which also showed some flavour into Western Australia and South Australia and regional Queensland. And obviously on the listing side, can you just talk to those sort of observations that you've got when we lift our eyes a little bit out of the CBD locations?
Yeah, absolutely. And we're definitely seeing a real mix in listing markets. So let's look at the areas that have seen the biggest rise in total listings relative to their 5-year average. So markets around regional Victoria really dominate this list. Areas like Ballarat, the Daylesford area as well, sort of number 1 and number 2 on the biggest change from the 5-year average. In fact, Ballarat listings are up about 61% on their 5-year average. Daylesford, Ballon, Creswick, that SA3 are up about 60%. Keeping in mind these areas have moved from remarkable lows, right? Through the pandemic, these were some of the, I guess, tightest purchasing markets in the country. So it's off a really low level and starting to rise. So arguably the 5-year benchmark is maybe an unfairly low benchmark to look at. Hobart is another one that's really quite heavily featured on these tables that show the biggest rise in total listings. And again, it's moved from a very low level. But a few different examples, we'll be getting into some of the inner ring markets of Melbourne. So Hawthorn, Stonington East, some pretty decent markets. Stonington's up nearly 15% on the 5-year average. Essendon's up about 13%. But remarkably, when you look at the trends in those two areas, they're completely different. They're coming down from quite high levels rather than a lot of the regional Victorian markets rising from very low levels. So it looks to me like some of those, remember, a lot of inner Melbourne markets really did it quite tough through the pandemic as a lot of people moved away from those inner city areas, moved to the outer fringes or the regional markets. Listing numbers were elevated for a period of time there. So you really need to look at those sort of trends through the pandemic to understand what does the irrelevance to the 5-year average mean. In some of these cases, we're actually seeing a fall, a clear trend towards fewer listings, despite those markets being above their 5-year average. On the other hand, look at some of the markets where listings are extraordinarily low relative to their 5-year average and falling really sharply. A lot of these areas tend to be in regional Western Australia or regional South Australia. So a really good example would be somewhere like, say, Albany in WA. Coastal, arguably lifestyle market, relatively affordable. It's benefiting from a pretty decent rate of internal migration down there. And we've seen in that market about a 63% fall from the 5-year average. And again, plotting that data out in trend terms, it's absolutely plummeting. It's showing no signs of turning around. So I think buyers looking into some of those regional, more sort of lifestyle or coastal tree change style markets, outside of your sort of more popular areas around Victoria or New South Wales, to a lesser extent Queensland, are going to be finding that stock levels are really tight and finding options to buy are pretty scarce, and they're selling really quickly amid those really low supply levels. So yeah, definitely chalk and cheese when you look at some of the different extremes in these listing numbers.
Can we talk about Albany? It's a great example. If I'm looking at the previous 5-year average, we've got 1,035 listings. We're now down at 386 listings. This is a classic case of when we look around for lifestyle locations around the country, which aren't necessarily commutable locations, that can sit in dormancy for a decade or even longer and then have their moment in the sun. And so, from an investor's point of view, people might be sniffing around these types of areas. And I don't blame them. The yields are going to look pretty attractive. The valuation is going to look pretty attractive in those areas. But just be mindful when you're making long-term investment decisions of that sort of 20, 30-year period. What you've got to be asking yourself is, what is the driver that's going to have that growth sustainable? So you might pick the market, you might time the market, you might get that nice little 20, 30% rise, but then just be prepared that you're going to be sitting on that property for the next maybe 10 or 15 years. We don't know. I mean, obviously population growth and, baby boomer cycles and all that type of thing. But you've got to ask yourself is, what is the industry? What is the thing that's going to drive that? Right now, I suspect it is a lot of retirees going down into that particular marketplace and that type of thing. But what's the engine room of the economy down there, and what's going to be happening in those for that long-term sustainable growth? Is that a view you also hold, Tim?
Yeah, absolutely. And it's so important. There's countless examples around the country. I'm looking at the list of where listings are really low, and there's so many other examples that are very similar to Albany. Well, you've got Margaret River, right? That's a little bit more diverse, but quite popular and well known. It's got a good brand. the Barossa, you've got the Limestone Coast in South Australia, you've got Bunbury as well in WA. But you could even go to some other markets, look at Cairns or Townsville. I mean, Townsville's a really diversified economy, but that market's done it tough for the last 15 years, despite its diversity, because it is quite connected to the resources sector and has had some pretty severe weather events coming through as well. So absolutely, they'd be looking at the diversity of the economy. And for investors, it's really important to be looking at those long-term drivers of capital gain. And to your point, I think they can look remarkably appealing on paper, but say over a 5 or 10 year period, you'll probably find a lot of those demand side drivers just dry up, and there isn't a great deal of economic growth in those areas, despite low supply levels.
Well, that's the classic case if you get too many investors in there who are sniffing around because it's the next hotspot. And you've got all of this extra, supply coming in. I mean, I know we talked about Hobart a lot in terms of a lot of investor activity that went in there, and it did a tremendous amount of growth over that particular time. But if I look at your weekly release and I see the amount of vacant property, there is no rental shortage in Hobart at the moment, in terms of its vacancy rates and so forth. So that's that irrational behaviour, and so what we're trying to teach people is, you can absolutely get the timing of the market well, and potentially get a nice little kicker of equity, and you can add on to that because you've got the yield. But our story is around quality and sustainable quality over a long period of time. And so you can run the risk of some of these markets which are going to give up some of that gain. So even though the demand supply looked amazing at that time, the score was brilliant as per our algorithms as well. We're also thinking beyond that cycle and thinking about what's going to sustain it, what's going to make it, basically have that confident growth period over a long period of time. Because we know Hobart, I think it was back in 2007 or 8, had a 50% growth in like a massive spike, and then effectively did nothing for the next 15 years, similar to the Townsville story.
Yeah, absolutely. So diversity in the economy and looking for economic drivers. Infrastructure is always a really good aspect of the marketplace to be looking for. Southeast Queensland is going to be, not the epicenter, but it's going to be have a lot of infrastructure associated with the Olympics coming over the next 9 years as well. So I think when you look for those really important drivers, they quite often aren't going to exist in some of your smaller regional markets, even though they might be quite appealing from a lifestyle perspective or a retiree. For an investor, making sure there's going to be sustainable rental demand and capital growth, much more unreliable.
As a native West Australian, it was refreshing to hear you both say Albany correctly, which is good. But I think the important point there is that it just depends on what game you're playing as an investor, and that's a trap that a lot of investors make, that everyone is playing the same game. So some of the things that you two lads have been chatting to is if you're a short-term investor who wants to get into a market and pick it, ride a little bit of a spike, and then ideally pull that money out. We would say pull the money out, keep the asset, play the long game. But if you have a short-term perspective, that's okay. But if you're playing a long-term game where you only want to, Ben and I were talking to this point before, if you only want 2 or 3 good properties, combine it with your super, hold it for the long term, well, then it's probably not the game that you want to play. Whereas that there are a small minority of people that like to accumulate 10 and 15 and 20 and 30 properties. And if that's the game that you want to play, it is very much the minority game. You are going to be up against it because governments will probably come for you. They don't want to see people having big, large portfolios like that. So I think that's a distinguishing factor, to be really clear on what game you're playing. And if you're clear on that, well, then the discussion that we just had, rewind for the last 10 minutes, sort of has a bit more context. Hey, Tim, in the report, you talk about activity in the real estate sector as a sign for listings as well. Before you talk to that point, could you just rewind a little bit for the people who are listening to this who are not involved in the real estate industry at all? I mean, we are, as a company, we are a subscriber of your service, but can you tell people what that looks like and some of the activity that real estate agents can do in the background first, and then why that activity matters?
Yeah, great point. So I think you're talking about the RP Data platform, which a lot of real estate agents and property industry professionals use. So essentially, RP Data is a platform where you can research individual properties. You can see what was the last time they sold, what was the date, what was the purchase price. You can see some information about who owns it, the attributes of the property, the marketing history over the past couple of decades, all that sort of stuff. So a lot of industry professionals and also non-professionals utilize that platform to get an understanding of individual properties and market trends as well. So when a real estate agent will go to list a property, or even going back a stage, they'll go to meet with a prospective vendor and give them an idea of what their marketing strategy is going to be, they typically go along with what they call a comparative market analysis report, or a CMA. And they generate that off a platform like RP Data. And essentially the CMA will provide them with the nuts and bolts of the foundations that gives them an idea of what the listing price for that property is going to be. And they form that based on the attributes of the property and what's sold around that property recently. So looking for like and maybe adjusting for differences in that particular property or the vendor's expectations. So when we look at the amount of activity that's going on across that platform, it gives us pretty much a real-time view on how many homes are being prepared to come to market. There's generally about a 2 to 4 week lag between when we see a real estate agent preparing a report for a property to seeing that actually ending up on the marketplace. So it's a lead indicator for fresh stock coming on the market. It's pretty clear that CMA activity, or real estate agent activity, has been lifting. I mean, that's been a precursor to this early trend in new listings we've been seeing, and it's continuing to rise. So again, that's just tells me that spring is shaping up to be busier than what it has been the last couple of years, which it's about time, I think. Compared to last year, spring was a bit of a non-event, and we need more supply coming into the market. There's not enough choice. But again, if I'm right and we continue to see that rising without any real commensurate uplift in buying activity, then I think that's where we start to see a healthy rebalancing between effective supply and demonstrated demand.
Tim, in terms of we've obviously focused on the here and now for the spring selling season and coming into obviously early 24. That's that sort of very, very short, narrow window. And to your point, I think the risk is to the downside in terms of when we're talking about the national property valuations because of Sydney and Melbourne, and those listing increases. We have talked about the hot markets of Perth, Southeast Queensland, and also South Australia and some of those regional areas in there. In your mind, what are the, taking the medium-term view, what are the sort of main catalysts that you would see that would also drive further demand into the market? I know the obvious ones, but I want you to say them. But yeah, tell us a little bit about what you think will be the turning point when we probably come from this slowing of valuation growth into a market that's probably going to then see more upside.
Well, the key factor is going to be sentiment, I think, and sentiment stems from a whole bunch of other things. So consumer sentiment, there's a few different indicators in the market you can follow. ANZ and Roy Morgan produce a weekly indicator. Westpac and the Melbourne Institute produce a monthly indicator. They both show pretty much the same trends, that sentiment's holding around the low levels we saw through the early phase of the pandemic and about where it was during the global financial crisis. The difference between those two periods is sentiment held at those really low levels for only a couple of months through those previous examples, whereas now we've been seeing sentiment holding at these really low levels the past 10 months, nearly a year. So watch for a turn in sentiment. I guess it is probably just around the corner. We probably will start to see sentiment rising from these very low levels alongside a growing expectation that interest rates have now peaked and that inflation's falling faster than what the RBA was expecting. But sentiment needs to rise a lot to get from where it is at the moment, even just to back to average levels. So I think the things that will really drive an improvement in sentiment will be, as soon as we start to see interest rates coming down, I think that's probably game on. Alongside a drop in interest rates, you'd have to think that APRA will ease back on their serviceability buffer. That's currently at 3 percentage points, maybe drop it back down to 2.5 percentage points. And that also implies that inflation's become under control. Maybe not necessarily back into the target range by the time interest rates come down, but that's probably not until 2025. Hopefully, rates are coming down sort of mid next year or through the second half of next year. So I think that'll be the key one. And as soon as we start to see inflation getting back into target range as well, it simply means that the cost of living pressures aren't biting as badly either. So I think they'll be the key ones to watch, is really interest rates and inflation feeding into consumer sentiment and how consumers feel about their own economic and financial situations. And once we start to see sentiment getting back to normal levels, that's where you'd expect to see a much more broad rise in purchasing activity, in housing activity overall.
Now, I'm conscious of your time, Tim, and so this is my final question. What's fascinating in the Westpac Melbourne Institute's sentiment assessment is the time to buy a property is still sitting in positive, optimistic territory. It's fascinating. It's so interesting to see where the general sentiment is quite low, but the time to buy a property is actually, sitting at a positive read. It's just really interesting.
It is remarkable, isn't it? And there's two sub-indices for housing in that index. There's the house price expectations index, which is looking all right as well, and then your time to buy a dwelling index. So you'd have to think, even though the time to buy a dwelling index has shown a bit of a rise, you'd have to think as sentiment rises more broadly and rates come down, that's when we'd start to see that index showing a little bit more, a little bit more oomph. But I think it just speaks to the fact that supply levels are so low that a lot of consumers are still picking the marketplace as a bit of a safe haven.
I agree.
There's a couple of key takeaways for me today, Tim, is obviously for people to be wary of what to expect going into the spring season. I think the opportunity for our community and the contrarian thinkers is it's been quite difficult to actually get your hands on a piece of real estate that we would consider investment grade. So if listings increases, that gives our audience an opportunity to go, okay, great. Some of the A and the B plus properties that we would consider good opportunities, they should be starting to consider during this period. Because on the back of what you also just said was the fact, well, what will actually change the sentiment? You don't want to be making those decisions too close to those events that change the sentiment. Otherwise, you will start to get caught up within the slipstream of general thinking and mass thinking as well. So I think for me, for our audience, I think hopefully they have those two things. There is an opportunity for those that are prepared to get the types of properties that they would like, hopefully as they start to come through the spring season, but be ahead of the masses that do it all at once based on those sentiment changes. So Tim, it's always a pleasure having you join us on the Property Couch. You just make a lot of sense, and we understand that you're a busy man this week, so thanks for squeezing us into your schedule. On behalf of everyone here at the Property Couch, thanks for joining us again.
It's always a pleasure. Thanks, Bryce and Ben. Looking forward to the next one.
Thanks, Tim. You're a superstar.
There you go, Ben. Tim just happens to deliver the goods again. I really enjoyed the last conversation we had with him around the report that he did around the 30 years of property performance. I think that's a staple that everyone should listen to, and actually everyone should go and read that report. But today's was really interesting current affairs for what could be just around the corner as we tip into spring tomorrow.
Yeah, I think he's got the trend right that there is going to be markets within markets. It is very much a story of that. I think you're going to see cooling prices in Sydney and Melbourne as supply continues to arrive, and the trigger on the other side of that is going to be around when interest rates start to ease, and potentially when borrowing capacity buffers also are potentially reviewed. So what does that say to us, and what does it say to our community? That you may have just been blessed with this extra opportunity and this little window to be able to look at those two big markets as potentially buying opportunities for those people who are fortunate enough to be in that situation. But we also know from this information that, the markets in Adelaide, Perth and Southeast Queensland, and even some of the northern parts, like even Townsville, Cairns, are going to be interesting markets over the course of the next couple of years, in my view, because we're also forcing people into those affordable markets that we talked about when it does come to the investor tapping onto that. So, Tim, I think I'm really supportive of the ways in which he reads the market, and we're forever blessed to be able to get access to thought leaders like Tim to be able to, inform our views. And my final point here, Bryce, is I'm starting to see a lot more communication from property spruikers talking about the next big boom that's coming.
Yes.
And so I also want to put some warning signals up to some of that sort of dialogue, because I'm not sure. I mean, I think what I would like is a steadier, more sustained market with longer growth rather than these boom bust sort of cycles that we're come to expecting, this FOMO and FOMU. And so, yeah, that what would be nice is, transitioning back to where we were 10, 15 years ago with some steady growth and the fundamentals doing all the heavy lifting.
Yeah, well said. So a couple of things, 100% right that we're privileged to get the opportunity to chat with Tim. So thank you, Tim, on behalf of our community. And number two, I do hope that the people who are in a position to take advantage of the information that Tim just shared actually get that opportunity, Ben, because like you said, Melbourne and Sydney, if there is more listings, and they are more listings in the types of property that we want to pursue, because a lot of them we wouldn't be interested in. But if you see the opportunity to catch those A and B plus properties that have been historically difficult since the pandemic, to be honest, when we've been in a low listing environment.
Yeah.
Oh boy, oh boy, oh boy. When you get access to those properties, and then you get to fast forward 2 or 3 years down the road, gee whiz, that is a good opportunity. So
quality at fair value. Quality at fair value.
Yeah. Flight to quality. I love it. So, all right. My life hack today, Ben, is largely around something that a bunch of our community might already, you might know this too, but I love YouTube. I love learning from YouTube. And sometimes someone says something and I'm like, pause, rewind, write it down, because I've got a journal that I capture all these really great ideas that I learned from Jim Rohn many, many years ago. So if I get something cool, I want to write it down. I want to be able to remember it. Well, YouTube automatically generates a written transcript for every single video that it uploads to its website. And I probably deep down knew that, but it's not obvious where it is. So when you're watching a video, there's 3 little dots down the bottom. So if you're watching a video on desktop, on the right-hand side, it'll feed up a whole bunch of other videos that you should do. If you hit the 3 dots, it'll give you 2 options, and one of them says show transcript. You hit show transcript, and where those videos appear, they disappear. And then all of a sudden you can start to see the transcript, which has been amazing. So for anyone who is
cut and paste rather than typing.
Yeah, well, it just means I can get it done quicker, and I don't have to rewind and what it's saying. Can I get it done fast enough when I can't type quick enough and all that sort of stuff? Or in this case, I can't scribe in my journal quick enough. So for anyone, I guess it's a life hack for anyone who A, loves YouTube, B, loves learning from YouTube, and C, loves writing down great ideas that they found on YouTube. The transcription service is very good, very helpful, and has been a little game changer for me. So there you go. That's today's life hack, mate. What's making property news for you?
Well, just building on the spring selling season, we know that the likelihood of record number of auction listings coming up this weekend. So it'll be the biggest weekend that we've seen this year, potentially over 2,000 into that sort of 2,100, maybe even 2,200 is what we're sort of forecasting. So that's quite interesting. Obviously, we saw the auction clearance rate results from last weekend nationally, seeing the clearance rate sitting around 69.9. So it just dropped under that 70%. So this is about testing, the depth of demand that we were talking about before. So we also know that, obviously I'll be doing my economic and RBA update next week. So I'll be able to release the results that were the August numbers. But we do know we are seeing continued growth in some of those markets as well. So a really interesting time for the property market, certainly being tested with this new supply coming in. It's just how much supply is going to be coming is something that we'll be talking about on a regular basis. So that's really the biggest property news. Now we've sort of got rental caps and rental freezes sort of behind us. And so really the thing that I'm focusing in on now is, where are those opportunities in the market around the country and what do they look like? So we'll keep everyone abreast of that over the course of the spring and into the summer buying and selling season, Bryce.
Yes, very good. So we'll keep an eye out on that. It's very interesting, and see how that plays out for what Tim was talking about today. So, mate, it's been fun. It's always great. We're in a bit of a guest season
Yes.
at the minute. So we've had some great guests. Now next week, first time guest, and this person has actually worked at the RBA and is going to talk about some of the machinations of what happens inside the Reserve Bank Australia when it comes to property. So wonderful insights that that you and I are looking forward to unpack further and sharing with this community, mate. But until next week,
knowledge is empowering, Bryce, but only if you act on it.
Only if you act on it, folks. See you next week.